everybody, this is Jimmy from Joint Ops Properties. Today's video is going to be a part of a webinar from Atlas Wealth Solutions. Brad and Ryan put this out to their customers a couple weeks ago, and quite frankly, I'm going to steal it, put it up on my video, because at the end of the day, these guys can sell private lending better than I can. I hope you enjoyed it, and take a look at private lending from somebody else's point of view other than mine and Bob's. Talk to you later. Bye.
Now to the residential, the lease option type of loans. So we call these rehab loans. And this market's a little bit different, right? You're typically dealing with lower amount of money. On the previous example, we were talking about $2 to $20 million. So in all likelihood, if you're investing in those type of loans, you're not doing it yourself, right? You're right. Investing with a group or a pool of other people. With these loans, we're looking at anywhere between $50,000 to $200,000 in actual capital in. And there's a real need for this type of stuff because real estate investors in today's markets, they have a hard time scaling and growing portfolios simply because of lending requirements from a bank, right? I mean, banks will kind of cap off and cut off how much lending they'll offer to individual investors. And these investors, they need money to be able to be speedy to the deal. That's what wins, that's what gets the right properties if they've got the capital available to do it. So speed to the deal is the key. The next thing is we want to capitalize on inefficient markets and local expertise. So independent real estate investors in a local market, they know their markets like the back of their hand. They know where to buy, they know who's renting, they know what to do, they know what the values are, and when a deal comes up, they can spot it in a second. They know, hey, properties in this area sell for X, this one came on the market for this, I can go in and do $5,000 repair, and boom, it's good to go.
But somebody that can do that in, let's say, St. Louis is not going to be able to do that in, say, Orlando. Because they're different enough markets, even though it's a very similar property type, it's got to be very specific to that market, which creates all kinds of inefficiencies because it can't be broadly applied all the way across. So you could find all these pockets of value and be able to take advantage of those. Where in the commercial market, it does get a lot more level playing field, right? So we don't get that. So that's why this is still a very interesting option for an investor to be able to look at.
And one of the last things, and this is probably one of the things I like the most, when you're participating in these type of loans, you have a lot more control, right? On one of those loans above, unless you're bringing $20 million to the table, you're involved with other investors, right? Which means you technically decrease the level of control that you have over the investment. If there's something that needs to be done, a lot of times they're brought to a vote in terms of, hey, do we want to sell or foreclose on the loan? Do we want to do this on the loan? If you own if you bring $50,000, you own the house. You're the bank. And if something goes wrong, you determine, do we sell it? Do I keep it? Do we foreclose? What do we do on the property? You're in control.
And the decision behind those is fairly easy for an individual to make. It's a small home in a market that's easy to find comparables and a real estate agent and a team to help you get that done. If you have to foreclose on a hotel, I think a lot of you would be like, I don't know what to do next, right? So it allows for that level of control and expertise to be held with you, and you can make those decisions where on the other side, you've got to cede control of that to somebody who's going to be, you're going to hire to put in that position.
Now,
right?
and don't get too worried when we're talking about all this control. We're teaching the strategy here. We're going to connect you with the people that will help you actually facilitate.
Just like everything, I just want to be the CEO. Yeah. I don't want to do any of the work, but you need to understand the ins and outs of this before you'd ever want to participate.
For sure. It's education, team, an opportunity.
There you go.
Right?
Yep.
So we're going to go through this next one kind of quick. The private lending with rehab and rental loans. It's a lot of the same thing that we talk about, right? Non-conforming loan limitations. If you're a real estate investor, you bump up against this all the time. Your credit only goes so far. Same thing with the speed, right? Money wins the game, and a lot of times the best deals, they never hit the open market. So if an investor can show up and say, I've got $50,000 in cash, and I'm going to buy the property that's valued at $100, but I'm going to buy it for $50 in cash right now, that's what wins the game.
Yep.
And then again, the same thing with flexibility. So these are why private lending exists. And I don't know if you guys, there's a lot of this type of stuff cropping up and growing, is more popularity out there because the need is definitely out there.
Yeah, and technology is helping connect people much more efficiently, and this is becoming a little bit more well-known. But that also brings with it a little bit of danger because as a new opportunity, you might not know what to look for and how to protect yourself. Case in point, when I started explaining this to my brother, and my brother and I do a lot of investing together, we got very, very hesitant to get involved and do it. And that's because, come to find out, his roommate at the time had just, only a couple weeks earlier, the news was broken to him that he had invested in what he thought was a hotel deal somewhere. It was either Texas or Louisiana. And come to find out, the property never existed. They just took pictures of something else off the internet and showed it to him, put up this PPM, and the money was gone. And it was revealed to be a Ponzi scheme. And so he says, well, what you're telling me sounds exactly like what my roommate got sold, and we just found out he lost $100,000.
So there's some very specific keys to a deal that you want to look for to see if, out of all the opportunities, what opportunities are right and how can you protect and lower your risk.
Yep, and this applies to both styles of lending, okay? So the first one is we don't really care about the property yet. I don't want somebody to just send me over deals and let's take a look. I want to start and do some due diligence with the company that's putting everything together. Okay, a couple things to look at specifically is we want to see what their deal flow looks like. And what their history would be like. How long have they been doing this, and how often do they do it? If they're a one-hit wonder, we probably don't want to be around them. But if they've got good, consistent track record, that's something that we want to rely on. We also want to look at the level of the due diligence that they do and they will provide. Because again, you're not going to go inspect a 200-unit apartment building, right? You're going to have that company have attorneys and appraisers and real estate professionals that are going to handle all of that work, and you need to see what level of due diligence they'll provide you.
One other thing too, I mean, when we say start with a company, if we're talking about an individual real estate investor, look and see, does he own his own asset?
Yeah,
Right? If you're going to loan money to a real estate investor, does he do real estate himself?
Does he eat his own cooking? Right?
Yeah, does he have real estate in his portfolio? So you want to start with the company or the individual that you're going to be loaning money, and then everything after that becomes a little bit easier.
Yep. So all the expertise that they're going to bring to the table, you want to start and do your due diligence there. Okay. Next to that is, and this is probably, well, these do go in order. When we start to look at the property, the most crucial thing that if this isn't there, stop immediately. We need to be in first position on the property. And I even go one step further to where I want to be the sole lender on the property. Whether it's myself or the group that I'm going in with, we want to be the only ones investing on that property and extinguishing all other debt. That way, the lending group or individual remains in control of the property. And we've learned that second mortgages or anything after that, you have to so deeply discount them that they're really pretty much not worth much to us.
Yeah.
Okay. Third to that is we want to manage our loan to value ratio. Okay, so real quick on this is the amount of the loan divided by the value of the property. Okay, so if you've got $1 million property, what's a reasonable amount to loan on this? And the reason we want to look at this is really a good gauge of your risk. If you think about volatile markets and what happens to valuations. Valuations are merely opinions. Now, they're very professionally done and put on paper and they look formal, but at the end of the day, it's just somebody's opinion of what it's worth.
And what happened to people's opinion in 2008 of real estate?
Well, it was going up and then it didn't.
And then it changed.
Right? And that was overnight. There were properties that within a few weeks, the valuations were changing.
20% lower.
Yep. So we want to manage this and give ourselves enough flexibility. So how much is enough buffer on this?
So this is our rule of thumb. Now, as we looked at this for ourselves, we wanted to make sure there was plenty of buffer. And so we tell people, don't go above 65% loan to value. So if you're looking at $1 million property or $100,000 property, don't loan any more than 65% of the value of the property.
Yep.
And what this does, the way it protects you, let's say something does go wrong, right? Let's say you step in or the servicer of the loan steps in and has to foreclose on the property for whatever reason. We want to have the ability to discount the property and sell it quickly, and that's how we get our money back, right?
Yep.
If you loan 90% of the value of the property and you have to step in and sell the property, but the value of the property went down to 80%, you've got an issue there, right?
Yep.
So you want to build in enough buffer, and that's what protects your capital.
And one other big part about this too is apart from the property, it ensures that the borrower has skin in the game, right? If they borrowed all of the capital in the deal, what risk do they have of walking away?
Yeah.
Not much. But this way, if you've only lent 65%, then who has the other 35% of value? It's the other person, so you're partnering more with them.
Very good. So the next one, we want to make sure that we have a short time frame. When banks step in, they lend money for 25, 30 years. that's not going to work for the typical everyday investor, right? We want to lend our money for 12, 18 months, maybe 3 years, and there's some differences of if we go longer, what we need to have involved in the deal. But we want to have a short time frame. What that does for us is it, again, minimizes risk. If something does happen, we've got enough, we're not stuck with the property over a long period of time.
Yeah, how many of you out there know exactly what you're going to do 14 months from today? That's an eternity, okay? If you're going to be in an investment longer than 12 to 18 months, what we say is you need ownership in that. You need to take an equity position. And we're only talking about lending here. Ownership, that makes sense to be in it for 30 years. I want all of the upside that comes with ownership. If I'm not going to take ownership, I'm going to cut my time frame down to 12 to 18 months.
You got it. The last one, this is just another way. We're talking about preservation of capital, limiting risk. You want to have multiple exit strategies. If you have to foreclose on the loan, you want to have the right loan servicer that can come in and say, hey, no big deal. We're going to sell it, or maybe we're going to keep it and rent it, or maybe we're going to do some improvements and we're going to up the value and do something else with it. But we want to have multiple exit strategies. That just gives you more choices, more options to pick the best case scenario for something that might go
And we say you need at least 3. Everything does exactly like you said. That's option number 1. We can foreclose and sell through our LTV. That's option number 2. Or 3, we have a servicing company that can take over, or you yourself can take over and profitably operate the property. Those are at the minimum 3 exit strategies that we need.
You got it. So any loan that you're looking at, whether you look at some of the options that we're going to share with you, or you're looking on the open market, that's what you want to look for before you make any action. You got it.
So big things there.
So let's look at the residential. Same type of thing, but this is, again, another loan that just came out just a couple days ago, right? So this is from one of our providers out in Missouri. And this loan was single-family home. The value of the home right down here, let's see, the loan amount was $48,000. The collateral value, $89,000. Now this was an independent audit, $89,000, but the comparables in the area, $110,000.
Yeah, now this is another point, because we talked about we want to sell to an investor who has experience and knowledge in what they're doing, and they showed us comps. Actually, we saw a couple in the neighborhood up as high as 130, but they want to offer the property to their investors at an $89,000 price. So how many people out there want to buy a $110,000 property for $89,000, right? That creates a lot of demand and a lot of excitement, a lot of security for us as the lender. And we only had to lend $48,000 against this property. So depending on which of those valuations you want to take, we're between 44 and 54% LTV.
Again, just more, the way we get a better rate of return is by minimizing our risk, right? Yep. And we want to have, the LTV is one way to do it. Short time frame. Now this individual that's doing these type of loans has a very, very unique program out there that he calls lease option, rent to own type of stuff. He gets people in, rehabs their credit, helps them legitimately helps them buy the property at an increased value here. So the loans are a little bit longer, anywhere between 12 to 24 months.
But again, this is another example of value add. Why would somebody come in and buy this house? Because we use somebody that is offering more than just a home here. So when the market's going up, when the market's going down, he's got a unique proposition that makes this property pretty valuable. Yeah. Okay, just like the commercial side, it's a very similar thing. They're working with the borrower to improve the property or improve the situation.
Well, and another thing, and this is what I love about these type of loans, you're in control, right? Mm-hmm. You are the sole owner of the property, right? Yep. You're in first position, in control. And this particular individual that we do work with out in Missouri, he negotiates these loans on a one-on-one basis. So if you want a longer time frame, if you want an equity position on the back end, if you want a shorter time frame, because you're in control and you're not negotiating with 10 other investors who are also putting money in, you have really a seat at the table. Yep,
you can make that decision. And how many out there can get their head around having 50% equity in a $90,000 rental property? I mean, even if you don't know St. Louis, that's not a bad position to be in, and you'd have options to figure that out.
Well, and here's the cool thing, right? I mean, we've been talking about all the things to look for and how to reduce your risk and all of this, but we started off this webinar saying this is all about growing your capital. And I don't know about you, but I think most people today are nervous, scared about the stock markets. They go to the banks to get CDs and interest rates there and maybe bonds, and you're looking at 2% returns maybe. Mm-hmm. I mean, we just threw up 2 opportunities here, one at 12%, one at 10%. Those are double-digit rates of return, backed and collateralized by first position real estate.
Yep.
That's a pretty awesome opportunity.
Now, let me push on this, because a lot of people say, well, if you're buying stock in GE, you're backed by one of the most successful companies out there. let's talk about hierarchy of capital for just a quick second. Okay. What people don't realize about the stock market is somehow we've been convinced that the best position we can put ourselves in as an investor is the bottom of the totem pole. The very last person to get paid. What you need to understand about common stock ownership is there are a whole bunch of people in line in front of you to get paid. They got to pay their employees. They got to pay their vendors. Then who do they pay? Lenders. Debt service is taken first. And then there's a whole class of preferred stockholders that get paid. And then the very last person. So all those people are in front of you. If we're talking about first position, the stock market is anything but first position, right? But here you're in first position on an asset that's worth 60 or 70% of what you've put into it. There just isn't anywhere out there that has that type of security that can pay anywhere near these returns.
So a lot of our clients, you guys come to us and you've got money stacked up in IRAs and 401ks. And we all know that your money feels a lot like it's in bondage at that point, right? You've got your money in these accounts. If we want to take it out of the accounts, there's tremendous penalties for doing that. So oftentimes we don't encourage that.
Yep.
But can you use qualified money for this kind of stuff?
That's probably the most exciting part of this for most people is everyone feels, when we share the pyramid, they all feel like this. Like, I've built everything upside down. I have everything in the market. But because they have 60, 70, 80% of their net worth up there, it's locked up and they can't move it down the pyramid and reorganize. But with these opportunities, a lot of them, not every single time, but lending is almost always allowed within a qualified plan.
Okay, and
it's very simple to do.
Both of the team members that we're going to share with you today, they both allow qualified money, and that was one of our key indicators when we started looking at this. Is okay, how accessible is it to the average everyday person?
Yep.
So qualified money, thumbs up, good to go.
Yep.
Let's jump in. As we shared those introductory webinars, this was the strategy I think that we got the most feedback on from you, our clients. So this is why we decided to start off here.
Yep.
Every person has a unique plan. Every person's in a different situation. But we started off this webinar showing you and telling you how can you get real estate-like returns without doing real estate. And that's what this is all about. We gave you the basic strategy here. Now, when we talk about this, it's all about education, which is what we did tonight. But now comes the exciting part, the team and the opportunity.
Yep.
So Brad, how do we do this?
So what's next is, again, if you haven't gone and created your account, do so. If you don't know how to do it, email us, we'll get you set up. But in there is more education, and this is all going to be housed. Again, we're kind of on the growing wealth side of things. So that's where we want to focus. That's where it is. But to get this information, we do want to help everybody understand which of these strategies is going to be the best fit for them and make a personal connection with it, because a lot of the groups that do this don't take just anyone. They want to deal with sophisticated investors. So you now know what you're looking for, so what we want to do is, again, there's the Let's Talk right up here at the top of the page. You can click in there, grab a 30-minute consultation. Now that you know all about this, we can strategize a little bit about how it's going to fit into your plan, and then make the connection that's going to be the best fit for you.
So we've got two connections that we're super excited to bring to the table, where we've vetted, we've done our due diligence, we've verified that all 5 of those key elements are present, and now we get to introduce those people to you. Our team, the people we invest with, the people we work with, we get to introduce them directly to you. Yep. So take that time, schedule your time slot. If you haven't connected with us over these last couple of weeks, we're super excited to connect with you on a one-on-one basis, because Brad, for you and I, this is what started changing our lives. Using these strategies, we started seeing what we can do now, and we can shrink our timelines to where it doesn't take 30 years, it doesn't take 40 years. We can do it in a much shorter time frame.
And you get to invest like the wealthy do on a regular basis, and you get to get off that roller coaster. You get to exit that casino of